Good day, everyone, and welcome. I'm very happy to be here today, albeit virtually, to welcome you and to introduce the annual Capital Markets Conference with our colleagues and friends from the BWF. And I'd particularly like to thank Michael Sterzenbach, the BWF Secretary General, for the great cooperation and collaboration over many years, which makes events such as this possible. As just mentioned, we have been collaborating with BWF to produce this conference every year since at least 2009. And now that seems a very long time ago, and indeed it was, in many ways, a very different world. As an association, we were at that time helping our members deal with the effects of the great financial crisis. And although we already had by then perhaps some idea of the scale of the new regulation of global financial markets coming down the pipeline in the wake of the crisis, I don't think we can possibly have imagined the challenge that was to come and that it would occupy us for so many years. And yet here we are, 12 years down the line with much of that re-regulation behind us, focused on the new overarching themes in the capital markets, the importance of sustainability and taking on board the disruptive potential of fintech and crypto. At the same time, Europe and the UK are learning to live with Brexit, but nevertheless, the emphasis today on the agenda is still on the regulatory environment for financial markets and financial firms. Our session today on transparency and the consolidated tape for the bond markets is a topic very dear to our hearts at ICMA, and one on which we've spent a good deal of time over the years. It's a subject of much discussion and a number of ICMA papers. We support the creation of an EU post-trade consolidated tape for bond markets because such a centralized, accessible, and affordable source of appropriately calibrated, aggregated post-trade data will bring transparency to aid price formation and decision-making. And this will benefit end investors, large and small. Since and even before the European Commission announced earlier this year plans to include a consolidated tape for bonds as part of its review of MiFID II, ICMA has worked closely with the regulatory community to provide the market view on what will and will not work. So we're excited then that we've reached a point where this may become a reality in Europe, greatly to the benefit of investors in EU markets and to the efficient and effective functioning of the markets themselves. We're very happy to have a representative from the European Commission represented on our expert panel. In the other panel, the second panel, we're looking forward to a first review of the new prudential regime for investment firms, which came into force this year. And again, we're very pleased to have a regular contribution here, alongside the informed views of a cross-national array of fellow trade associations representing the buy side in Europe. But with that, I'd like to thank in advance all our panelists and speakers, and to thank once again BWF for co-organizing this event. Very much hope that you enjoy today's conference, and of course we're all hoping that next year's will again be in person. But to open today's proceedings, let me introduce our first speaker. We are very honored to have with us today Dr. Jörg Kukis, the State Secretary for Financial Market Policy and European Policy at the Federal Ministry of Finance of Germany. Dr. Kukis, I really don't think you need any further introduction, particularly for this audience. So I'd like to thank you personally for speaking today, and we're all looking forward to your comments. Over to you.
Yes, thank you. So I'm very happy that these topics are at the top of your agenda, and of course the discussion around CMU and what should be the next steps is gaining momentum. We used the time of our council presidency in the second half of last year to put forward council conclusions that are quite ambitious on the topic of CMU. They were unanimously agreed. So in that sense, the mandate to the Commission is very clear to move ahead on Capital Markets Union. I think we achieved a lot in the final stretch of the term of the last Commission and European Parliament, and it's very important that the legislative proposals that are now in progress continue that. And of course, as a response to the pandemic, we've already achieved a few steps forward in the recovery package of MiFID. I think a big step forward is, of course, the fact that in the funding of the Next Generation EU, the European Commission will issue several hundred billions of European AAA rated assets. So in that sense, one of the big deficiencies of the capital markets union that has always been highlighted, namely the absence of Europe-wide safe assets, or the lack thereof, is certainly now being addressed as sort of a corollary of all of the crisis response instruments that we have. But back to capital markets union, of course, we really see the momentum. We see a lot of support. We just have to now make this concrete. I think it's very obvious that Europe is lacking and lagging behind. There have been some papers published just yesterday that illustrate that very broadly and very clearly. The depth of the markets in terms of capital markets financing is insufficient. The volume of the markets is insufficient, and of course, the departure of the United Kingdom from the European Union aggravates the issue in terms of the importance of the European Union's capital markets on the global scale. So in that sense, I think it's very clear that this has to be a very substantial priority. The first initiative that I would like to highlight, that I hope will come soon, and the Commission is already working on it and has the consultation going, is of course the ESAP product, the European Single Access Point, that will do something that goes exactly in the direction that you mentioned, namely transparency. It's called the EU EDGAR in some circles, and if you see what progress transparency has made in the United States as a result of the launching of EDGAR, I think this could be a really promising avenue forward for accessibility of information, facilitation of cross-border investment that comes upon that, and making sure that the reporting obligations of the companies are leveraged into a broad investor base. So I think that's something that is upcoming. The next project that I would like to highlight and is also in the cards coming soon is LTIF. I think you're all aware how important that is, and of course, reviewing the requirements for that and making some adjustments is something that will be important, and it will also, of course, be an opportunity to continue the work on the securitization framework that we already launched in the MiFID recovery package, and put it on a even bigger scale. So in that sense, I think those are initiatives that are important. But of course, as I mentioned several times already, for us, a project that is near and dear to our heart is, of course, the question of MiFID. In the recovery package, we achieved some progress, but not a lot, I would say, going in the right direction. But one of the concerns that we received from many member states and in part from the Parliament is, of course, that there wasn't a very clear linkage to the crisis response necessity. And quite a few projects where we would have liked and supported more ambition were moved to the more comprehensive review of the MiFID II framework. So I think that is plausible. But now, of course, as the MiFID II review is upcoming, we now have to deliver. So I think that's important. We made progress on investor protection. We made progress on investment research. We made progress on commodity derivative markets. But I think in many of those areas, of course, a more fundamental review is necessary. Many of you have read and shown interest and participated in our consultation that we undertook in 2019, leading to our two consultation papers, one of which focusing more on the investor participation side and facilitating more access of retail investors to European capital markets, the other one on market microstructure. In the area of market structure, I think there are several priorities that will be important for us as the German Ministry of Finance. On the one side, of course, we appreciate all of the work that ESMA has done and will continue building on that. I think one of the issues that will be discussed in the review is, of course, the question of level playing field in equity markets between different trade execution venues, including systematic internalizers. Of course, in that note, it will be necessary, as we also highlighted in our paper, to look more carefully at the issue of double volume caps. Then, of course, as the title of this event illustrates, transparency will be a big issue. We think that's important both in bond and derivatives and equity markets. So in that sense, we are looking to proposals on how the waiver regime should be developed further, simplified. And of course, as you know, we are keen to work together and to get more input on the potential reduction of the cost of market data and how to improve the quality of reference data. So in that sense, I think all of these issues are going to be important. On the consolidated tape as well, we are expecting proposals. We think that a consolidated tape can help, if designed properly, to overcome the fragmented reporting landscape in the EU, and of course also to contribute to the reduction of the high cost of market data. So in that sense, we also think that your proposals or your ideas are going in the right direction and can generally be supported. Of course, a consolidated tape has to be economically viable. So the devil will be, of course, in the detail of design on how to meet the demand of users to get access to timely data, accurate data, and how to make sure that we properly inform market participants. Of course, on the other side, we have to accept that a consolidated tape will not be a panacea to addressing all of the complaints to the issues of cost and transparency. I think that goes without saying. Investor protection issues continue to be of course, very important. In the recovery package, we found some solutions and compromises on some of the most pressing issues. For example, information requirements for professionals or research. However, we think that we're only part way finished on that topic, and of course, that goes both for the content of the ideas that we have, but also for the full implementation. And of course, we have to take step one in terms of the changes in MiFID II, but we also have to make sure that everything that we do in one piece of legislation is also reflected then. And in this case, of course, also changes to PRIPS may be necessary. And additional reforms on the product governance framework. So in that sense, I think we've gone in the right direction, but we both need to think about the scope and the content during the review once more. But I think that's normal. I know that the topic of bonds with make-whole clauses is something that is on people's mind here. I personally think that's an issue that needs to be simplified. The simplification is an important first step to make such bonds eligible for retail investors. But of course, with respect to PRIPS regulation, further steps have to be taken. That is something, by the way, that in our MiFID consultation in 2019 attracted the highest number of comments. So in that sense, I think it's very important to make sure that we synchronize all elements of our rule rule set there to make sure that the reforms that we intend also achieve the final and ultimate goal of stronger retail participation in the European capital markets. We don't think that the intention of PRIPS was ever to deprive retail investors of the possibility to invest in products with features that makes these products safer. For example, make-whole clauses. Whereas other products that don't have this safety feature can be acquired without PRIPS kits. So in that sense, I think we just need to apply some common sense to the rule set to make sure that this goal of stronger retail investor participation in markets is achieved. It's promising that quite a lot of the numbers that we're seeing from the German mutual fund industry for 2020 and the first half of 2021 is actually very encouraging. We see a very strong participation of retail investors in equity funds over the past 18 months. Some statistics even talk about approaching record volumes again. The IPO markets in our country are vibrant and are achieving levels last seen in the early 2000s. So in that sense, the fundamental market is there. We just have to make sure that the rules and regulations around that also meet the goals that we all are embracing. So in that sense, I think the goal is clear. One issue that is recently coming up and that will require further diligence is, of course, the topic of payment for order flow. ESMA has recently published a paper on that, and I think that's certainly something that needs to be explored further, and ESMA acknowledges that it needs to be explored further, as does BaFin and other supervisory authorities. I think it's very important to look very carefully at the pros and cons in terms of execution quality, true costs, and potential conflicts of interest. So I think all of those topics are also important. Of course, another topic on your mind is the new world for investment firms as a result of the prudential regime of the Investment Firm Directive and the Investment Firm Regulation. It's been a success that these rules have been passed, and that we have a set of specific rules tailored to the risk of these institutions. The criteria established between large, medium, and small investment firms means that we can apply the principle of proportionality. In Germany, the number of licensed investment firms is now 720. 640 of those are categorized as small and fall into category 3. Less than 80 are medium-sized, and only a very small number in the single digits belong to category 1, which are the large investment firms that are still subject to the CRR framework. So in that sense, the vast majority is in the small categorization, subject to much more limited rules. The national transposition law passed the German parliament in May this year. So the new law was set in force on time in June 21. We're at the moment in the process of an implementing act at the national level to accompany the legislation. As many of these rules are, of course, related to reporting requirements, we first of all made clear that the existing templates can still be used during the time where new measures and templates are set into force, which we expect to happen by the end of the year. So far, we're also still waiting for, at the European level, for delegated acts or implementing acts to supplement the IFD and IFR framework. In addition, IBA guidelines on remuneration are still being worked on. So in that sense, we will, of course, then revise our rules and regulations relating to remuneration if and where necessary. Of course, the BaFin will then, once the IBA guidelines are available, also come out with a consultation process. So in that sense, all of these things are still work in progress, but as you can see, a lot of wheels are turning to improve the standards here. While some of these things are still outstanding, of course, the national transpositions are still applicable, and the system of the prudential supervision of investment firms will be complete soon, and then we will have a clear picture of all of the effects, and then of course it'll be very interesting to get your feedback on this. Last but not least, the last point that I would like to highlight is our appreciation of a stronger link, as is intended by the Commission, between the CMU project and the Sustainable Finance Agenda. The objective to support the green recovery is something that we have embraced very substantially. As you've seen, we've become a very large issuer of green bonds at the national level. We came late to that trend, but we've fully embraced it and are catching up in terms of volumes, and our goal with our quite innovative standard is to have a full yield curve of green bonds, and in the process we are in the process of issuing them, so we will continue that project. We see a large amount of synergies, as we see a huge demand for sustainable finance in all sectors of our economy. And so in that sense, this is a market that is growing rapidly. And as I read yesterday in one of the reports, this is actually one of the areas where the European capital markets are global leaders in terms of volumes, in terms of scope, in terms of numbers of issuance. So in that sense, I think this is certainly something that we can build on. The Commission proposal for the EU Green Bond Standards will also become an important one and to watch. Of course, we are still using the ICMA Green Bond principles. The alignment with the EU taxonomy will certainly bring forth some challenges, but as we know, the project of EU taxonomy is a very strategic, very important one, and a key instrument towards achieving climate neutrality by 2050. For us, it is very important to strike the right balance between the climate ambitions on the one side, but practicality on the other. That is something that we're hearing in terms of the feedback on both taxonomy, the green bond standards, and other pieces of legislation. We're in very close dialogue with many market participants and the corporate sector on this in terms of making it an efficient tool. That is a key element for us.
Hello, everybody. My name is Michael Sterzenbach. I'm the Secretary General of BWF, which is the Bundesverband der Wertpapierfirmen, or the National Trade Association for Securities Trading Firms in Germany. I'm in this position since BWF became operative in 2004, so quite a long time. And before I take the pleasure to introduce our panelists in the second panel, I would also like to take the opportunity to thank Martin Scheck very much for all the years together we've been bringing up this bwf ICMA format to a successful conference series. I just looked it up. It was already in 2008 when we started this initiative, and we all hope, of course, that next year we will be able to meet again in person in the wonderful National Library in Frankfurt am Main. My name, as I said, is Michael Sterzenbach. I'm holding a degree at PPE, Politics, Philosophy, Economy. So before I started to work in the capital markets environment, I had a little bit of broader orientation. And I'm doing this for quite a few years already, and still with a great pleasure. Today's panel is named A Brave New World for Investment Firms, the first month under IFD, IFR. We have almost 3 months now under the new regime. And since this is really an international audience today, it is worth remembering that the approach the European Union did choose to regulate investment firms in the past has been quite unique. Since the days of Basel I, investment firms were basically ruled and governed and monitored by the same provisions like universal banks. So the new thing the starting point we have now is truly a paradigm shift with a new regime. And our intention today is not to explain the new regime. That's something we did already on a panel in 2018, but to have a look into the first experiences, implementation, and whether this new concept could so far deliver with respect to its promises. It's a great pleasure for me to welcome Peggy Steffen on this panel. Peggy is the head of risk with BVI, the German fund industry association. She's a trained lawyer who studied law in Marburg and Basel. She is known for numerous publications in legal journals. And currently, as she told me, she is writing on, not really a surprise, but we are surprised on the result, the implementation of IFD in Germany. Welcome, Steffi. It's also an old friend of mine is Emmanuel de Fournou. He's Director of Market Infrastructure and Prudential Regulation with the French Association AMAFI, the Association Française des Marchés Financiers. I think I met Emmanuel first in 2004. This were the early days of MiFID I. So we've been working together for quite a long time already on market infrastructural and regulatory issues. It is not only a pleasure, but a great honor for us to have Udo Franke today on the panel here, who is head of division of the Securities Markets and Exchanges with the German Ministry of Finance, and for long years, really an expert in the field of capital markets regulation. I think we could not have picked anyone better for this panel from the other side of the fence, to say, from the legislator's perspective. Welcome, Udo Franke, to this panel. And last but not least, I have the pleasure to welcome Piebe Tebum of FIA EPTA, which is the European Principles Traders Association. And we are also know each other for quite a few years now, mainly been together with Emmanuel and Steffi in Brussels and in London on different occasions in the course of the legislation of the IFD, IFR regime we are talking about today. I think the interesting point about Piebe is that his members, the principal traders, they come from different jurisdictions. So he's able to give us an insight today, the differences within different European countries with this regime. Before we dig into more detail, I would like to suggest that we open this panel with a short statement by all of the panelists, what your first impression of the almost 3 months of the new IFD, IFR regime are. Has it been a smooth introduction? Was it rather disruptive? So this would be, I think, the starting point, and I would like to start with Peggy, who can give us an overview of what her impressions are from especially a buy-side perspective.
Yes, thank you, Michael. What we can say, it is a bumpy start. The timeline for application at the end of June was challenging, but what we see right now, the outstanding level 2 and level 3 requirements at the European level are missing. So we need to deal with this challenge in general. But in general, we very welcome this framework because it separates the banking rules from the investment firm regime. And as Mr. Cookies mentioned in the morning, more than 700 German investment firms are affected. This includes more than 400 firms which provides portfolio management and investment advice with a limited license. This means with no license to deal on own account or to hold clients' assets. And if we compare the rules under the CRD framework with the investment firm framework, under the CRD framework for these firms, only 4 articles applied. Now we have in the directive of the IFD more than 60 articles, and the IFR more than 60 articles, in addition to the outstanding RTS and guidelines. And so what we can say, it is a very complex framework, and this is the challenge to deal for these kind of firms. The vast majorities of these companies are classified as small investment firms, but we also have additional requirements such as disclosure and reporting. And so if you ask me about the challenge, this would be the challenge to deal with the new requirements and the complex framework in general.
Thank you very much, Steffi, for this insight. May I suggest, Emmanuel, that you continue with the situation in France? I think it's quite a little bit specific because, as I understand, in France, many of the affected investment firms are subsidiaries of universal banks.
Yes, thank you, Micha. In France, we currently have 103 investment firms. You must have in mind that asset management companies are not investment firms in France. They are only brokers, but not asset management companies. Among these 103 investment firms, 8 of them are class one firms, and they will have to apply for a credit institution license. If we look at these 8 firms, 4 are systemic firms, but 4 are also, which was expected, 4 are also subsidiaries of French banks. This was expected, but this was not expected at the beginning, but it was anticipated. We may have 1, 2, or 3 more class 1 firms due to the last publication of the ABA calculation method. This was not anticipated and not expected, and it raised a real and actual challenge for these investment firms because they were not prepared at all. They have prepared to be class 2 firms, but not to be credit institution. I don't know the exact split between class 2 and class 3 firms. To be honest, I don't know how many will be classified as class 2 and class 3. In France, the IFD, the directive has been transposed. The work is over. We agreed with our authorities to minimize the outcome for an investment firms to be a credit institution. This is why we have put in place in the banking law a specialized regime for these investment firms, so long as they do not grant credit or do not receive funds for customers. In a nutshell, they will act tomorrow, as they are today, with more reporting requirements, but that will be the main outcome for an investment firm to be a credit institution. They will, in France, the new specialized regime is called établissement de crédit et d'investissement. I don't know how to translate it in English, but établissement de crédit et d'investissement will be the new specialized credit institution regime within the French banking law. Therefore, for those firms, the main challenge is to apply for a credit banking license. It's a huge amount, huge task to do, because there are a lot of information to provide to the European Central Bank. For Class 2 firms, the challenge is more technical, because they have to change their reporting regime. They have to go from CRD regime to the IFR regime. It's a technical challenge, but more or less people are confident that they will be ready by the end of the year.
Thank you, Emmanuel. Very, very interesting insights. Pibe, you are the third one from the industry here, and I think you also have interesting first impressions about your members dealt with the implementation of this comprehensive new regime. You're still on mute, Pibe.
Apologies. Yes, indeed, Michael, and thank you for having the opportunity to speak. And as you were saying in the beginning, indeed, my members are in different jurisdictions across Europe and the UK. We have members in the EU, in the Czech Republic, in Germany, in Ireland, and in the Netherlands, and then in addition also in the UK. And so actually we're celebrating our 10th anniversary as the European Principal Traders Association this year. And I think 70% of that time period, we have been very engaged with policymakers and other members of the industry to attain a more proportionate regime for investment firms. Because as you were saying in the beginning, the fact that investment firms were part of the CRR in the EU was a problem of proportionality, and we've been supporting very much this move by policymakers to a more proportionate regime. So we've been very supportive of the IFR. That being said, we of course, we also see some issues with proportionality. But before going into that, I think it's an interesting fact to consider that, especially since Brexit and the fact that firms needed a representation in the EU to continue their operations, we have seen a diversification of the makeup of European firms, with actually many more firms, investment firms, setting up business in the EU, and hence also the IFR, IFD becoming a much more material piece of legislation in many more European countries than perhaps was initially expected or considered. So I think there's a much greater importance for many more NCAs and ministries of finance of making sure that where still there remains parts of the regime to be implemented, for example, in the level 2, to make sure that that is indeed proportionate. So I will speak on those points a bit later, more in detail, but just wanted to give that intuition to the panel and to the audience. More generally, we see that in some jurisdictions, IFD, for example, still needs to be fully implemented, but we also see in some of the countries where my members are active that actually, in practice, the rules are already applied. And of course, we are discussing in particular IFR, IFD here, so the EU rules, but also just wanted to mention that we should not forget about the UK IFPR, which is the way in which the UK is implementing the IFR, where actually they have progressed very much. And given the breadth and depth of the investment firm community, I think the takeaways from how the UK regime is being implemented are very worthwhile to consider, and also to potentially use some of these approaches for where the EU regime still needs to be implemented.
Thank you, Pibe. That's very interesting indeed. Let's come to Udo Franke from the Ministry of Finance point of view. Not only the industry, also the legislators have been very much occupied with this big challenge of the transposition. What are your first impressions about the new regime? Is there already a clear picture from the regulatory and legislative point of view, or is it still a sorting out process?
I think it's a preliminary view that we as regulators and the supervisor BaFin has. In general, it's very welcome to have a proportionate regime now with tailored requirements for investment firms. In Germany, the capital requirements and solvency licensing requirements were traditionally set up in the Banking Act, and with the implementation of the IFD and IFR, these requirements have been transferred into a new law, the Wertpapierinstitutsgesetz, Securities Institution law, with specified and tailored requirements for investment firms. This has been set into force in time in June, and BaFin required the firms to have a self-assessment, and according to the self-assessment, as already mentioned, there were altogether 200 investment firms. The largest group are these class 3 firms, about 640, about less than 80 class 2 firms, and a couple of class 1 firms. The majority of these class 3 firms are portfolio administrators, large majority. And as far as the first experiences are, firms in generally can comply and have no problems to comply with these initial capital requirements. There are very few firms that might have higher requirements or might have problems with, for example, exchange this insurance approach with new capital that they have to raise. So the first experiences are very positive. But certainly, this is only a first experience. These are experiences. As I said, the classification is based on a self-assessment. This is also dependent on factors whose clear calculation still has to be codified in Level 2 acts. And we are still looking for first reports about how the new requirements will be applied in practice.
Thank you very much. Maybe one detailed question about a more formal issue. In terms of terminology, you said the act to implement the IFD is called the Wertpapierinstitutsgesetz in German. Can you shed a little bit light why we did choose this deviating term? Because, of course, we have the term Wertpapierfirma in Germany, investment firm as well, but there was a reason to have a new terminology, which, of course, needs to be explained in particular to our international colleagues.
Yes, the reason is some deliberations with our colleagues in the Ministry of Justice, and in German law, the term firm or Firma is usually only used in civil law matters like the Handelsgesetzbuch and other civil law legislation. So it should be avoided to use this term firm in supervisory law. Therefore, we switched from the term investment firm law to the term investment institutions law to make clear that this is a law that is located in the field of supervisory and regulatory issues.
Thank you very much for this explanation. I think in practice it will be still quite a challenge because, of course, we have both terms to be used because the IFR still uses the term Wertpapierfirma, of course, and it's addressing the same type of companies at the end of the day. We've learned that Germany took the approach to implement the IFD by carving out the investment institutions or investment firms out of the Banking Act completely, which was quite a challenge because there were of course a lot of interconnections between the Banking Act and other parts of legislation which were not not immediately connected, for instance, taxations and other issues. So a lot of attention had to be given to not to overlook or to create unintended consequences. I would be very interested to learn how other European countries did follow or did solve this problem of creating a completely new regime within a framework where investment firms before have been regulated very much like banks. Pibe, would you like to shed some light on this with your experience from different countries? For the technical process of legal implementation?
Yeah, thank you, Michael. So as I already said earlier, so my members are in Germany, the Czech Republic, Ireland, the UK, and the Netherlands. So we see, for example, in the Netherlands that the IFD implementation has been slightly delayed. So my understanding is currently in the level of the Senate. So the actual law to apply is expected with, I think, about 5 months delay. At the same time, we know that the supervisory authorities have basically communicated to firms that they should prepare themselves to apply the rules as they will apply once IFD has been implemented. So I think from a practical point of view, that delay has not had any real material effect. And I think broadly speaking, that has also been the experience with my members in the other EU jurisdictions. Of course, Germany, we just already heard about. I think interesting to see in the UK that the expectation for the regime to apply there is early next year. But given the different structure of the UK rulebook, the FCA has been publishing a series of consultation papers which combine actually what we in the EU call the level 1 and level 2. So there's already a quite detailed picture in most areas of how the UK will implement the rules, including some of the detail that is not yet available from the EBA. Hence also my remark earlier that it would be very worthwhile to look at some of the practical solutions that the UK FCA is suggesting to implement the rules in a proportionate manner. And generally speaking, we have welcomed the approach that the FCA has been taking. And of course, we know that the EU and the UK have become separate jurisdictions, but investment firms have very common characteristics, obviously, and the substantive rules are the same. So again, I think very worthwhile to keep a close eye on some of the solutions that are being proposed there.
Yes, thank you very much. Peggy, what was your impression? Was it the right approach in Germany to carve out the investment firms from the Banking Act completely? Or do you think this was an exercise which was not necessary, or what is your impression?
Yes, I think it was the right approach to separate the frameworks, because now we have a framework which is focused only on investment firms, and now we can discuss solutions for the practice. And I would like to thank you, BaFin, and also our government during the implementation time, because BaFin adopted a pragmatic approach and provided Q&As to help the investment firms to deal with the complex frameworks. And there was a very good ongoing discussion with BaFin and Bundesbank. And so I hope we can deal with these requirements in future. I'm a bit concerned about the approach of the EBA, because their recommendations are linked to the CRD regulations, and did not consider in any case the level 1 of the IFD framework. So we will wait what is the final outcome of the Commission, and I hope the delay is a reason for this, that they will check this very carefully and will be in line with the level 1 requirements.
Thank you, Peggy. Emmanuel, you already touched on the implementation issue. Could you give us a little bit more detail how the French legislator structured the implementation? You're on mute, Emmanuel. Can you hear us? Emmanuel, you're on mute.
Sorry. Okay. Pardon.
No. Okay.
Sorry. As I mentioned before, the main task for the French regulator was to introduce within the banking law the new specialized regime for établissement de crédit et d'investissement. That was
so
the
it
main
stays
task.
Within the banking law.
Yeah. Okay, and the purpose was to minimize the outcomes. For instance, in France, we've got rules on for banks on séparation bancaire. I don't know how to translate it in English. For instance, établissements de crédit et d'investissement are not subject to these rules. But that was the main regime. For investment firms, it was not necessary to change the law. And the main task was also to amend a huge amount of level 2 text, décret d'application in France. You've got a lot of level 2 texts, and we have to adapt and change those texts. It was about 100 texts that have been changed in order to comply with the new regime.
Yes, thank you very much, Emmanuel. Very, very helpful to see that there are different approaches in different countries how to follow this or to have this paradigm shift being implemented legally. I've chosen this panel name as A Brave New World for Investment Firms, not without a touch of irony, of course. The name comes from the 1932 dystopia of Aldous Huxley, of course. So it's seen a little bit, there's a question within this title, which means I would like to ask is, did the new regime really, from our point of view, from the industry as well as from the regulator's point of view, deliver? As we remember, the often stated gospel by EBA and by the Commission, and nowadays also by regulators, for instance, the Deutsche Bundesbank published an introduction to the new regime a couple of months ago in their monthly report. And they also stated that the intention was to make everything more proportionate, more risk sensitive, more simplistic. And when I'm talking to my members, which are basically all of them or most of them are class 2 firms, because of the existing 0 thresholds in 5 out of 7 K factors, which means that from the first euro you're trading on your own account, for example, you are not a class 3 firm, you're not considered to be small and non-interconnected anymore. So I would like to learn from your perspective, is this approach indeed something which is proportionate? Is it something new? Or is it in large amounts only, let's say, old wine in new bottles, which was copy-pasted from the existing banking regulation? So how satisfied are we with the overall outcome of this new regime from a design point of view? May I start this round with Udo Franke from the regulatory perspective? Are you satisfied with this? And do you think the new regime does deliver, has a proportionate approach, or do you see deficiencies with respect to the classification, for instance, in the field of securities trading, where all the firms basically are automatically class 2 firms?
I think it's in general it's a compromise, and the overall outcome is delivering, I think, a proportionate approach. 0 thresholds mean that firms that do certain kinds of transactions that hold client money, they must then comply with more sophisticated and higher requirements. I think this is a valid approach. Unfortunately, at this moment, there is only a kind of blurred view about the effects, because implementing level 2 legislation is still standing out, and this is necessary to really calculate the effects and get a full view.
Thank you very much. Peggy, from the buy side perspective, are you satisfied, or would you have chosen a different approach? I already indicated that we have some reservations because we are all class 2 firms, but for the buy side, I think most of those class 3 firms of the 600 firms are buy side firms. I think so. The same set of regulation means different things for different classes for different types of firms, it looks like. Would you agree?
Not really. As I already mentioned, the complexity of the framework is very burdensome, and we also have new rules for the class 3 firms, such as the reporting requirements. It's a different framework as it was before, but in general we can say the own capital requirements also for the class 2 portfolio managers are requirements which or we can deal with these kind of requirements. In particular, the key factor approach with the assets under management this approach is an easy approach, and there are some open questions with regard to the other key factors, for instance, how to deal with investment advice as part of the asset under management key factor, and how to deal with the client's orders handled if a portfolio manager also manages portfolios for UCITS or AIF investment funds. But in general, the fixed overhead requirements will be improved. What we have seen from the EBA side, the new proposals goes in the right direction, and our member already dealt with these kind of requirements. We are concerned a bit about the remuneration requirements because this is a copy pasting of the CRD approach, and this is not given under level 1 in the IFD. And so we hope we will see a new framework given by the Commission. And there are many open questions with regard to the group context. We have many investment firms being part of an insurance or a banking firm, and the proposed RTS are not on the table right now, and so it is not easy to clarify in the group context which kind of subsidiary will be part of the consolidation and which will not. And this is a challenge for these kind of firms. But in general, we can say our members can deal with this approach, and it is proportionate. It's just a burden for the implementation right now.
Thank you very much, Steffen. Peggy, you mentioned the group context. I think that's something which is particularly of importance for Emmanuel's members as well, isn't it, Emmanuel?
Yes, you're perfectly right. Yeah, yeah, it's one of the drawbacks of the new regime is that there are more requirements on a solo basis than in the previous regime. And for instance, firms will be obliged to put in place a remuneration or risk committees, which doesn't bring any benefits for anybody, and we will have more risk committee, remuneration committee, which is very burdensome for nothing. On the other side, of course, we consider that the K factor are more easier to implement and to understand than the CRD, CRR rules. We see that under the Pillar 1 regime, the capital requirement will decrease by about 20%, which is good news. We don't know what the ACPR will do with that, and the ACPR may impose a Pillar 2 requirement. But as for today, we consider that the capital requirements will be lower with EFR EFD than CRR CRD for Class 2 firms. That is very positive outcome of the new regime.
Interesting to learn.
And for class 1, as I mentioned before, the main challenge is to fulfill their dossier to the European Commission. And if I may add something, you mentioned Brave New World. I don't know if we are in a brave new world, but we are not far from 1984, because credit institution is an investment firm, or an investment firm is a credit institution.
Indeed, yes. People, what about your members? Do they see it as a brave new world, or do we still have to work on it to make it shiny and to deliver on the promise of proportionality?
Yeah, so Michael, my members are non-bank market makers, providing liquidity to exchanges and to end investors in futures and options and shares and ETFs and bonds. So as firms that are really in their setup completely different from banks in terms of the risks, in terms of how the business is run, the simplicity of the setup, we very much welcomed the proportionality objective contained in the level 1. So I would certainly echo some of the concerns that Emmanuel and Peggy also mentioned regarding some of the copy-paste exercises that we've seen, where approaches from the CRR have been basically put into the IFR IFD level 2, without giving real regard to the proportionality objective. And given the fact that our types of firms are much smaller, much simpler, and certainly do not have the scale to have all of these types of committees that were already mentioned, that is really something that we feel does not really fulfill the spirit of what IFR IFD was all about. And one observation that we have there is that there seems to be a lack of genuine impact assessment when developing these rules. And I would like to single out two specific dossiers in the level 2, which are of great concern to my members, and I know also to other types of investment firms. So one is with regard to the fixed overheads requirements regime, where we see a very strange thing that firms that deal on own account can no longer deduct their trading and clearing fees from the fixed overhead calculation. That is something that actually was possible and is still possible under the CRR. There seems to be, that's at least our interpretation, a misunderstanding to have been made in the draft proposed RTS. We have actually made the Commission and the EBA aware of this, but have so far not seen a solution to it. However, this is of significant importance given that as market-making firms, we trade very actively across European markets at large scale. And of course, all of our business is also cleared. So trading and clearing fees are very significant. And the concern is that this might very greatly increase the capital requirements through the fixed overhead requirement, which would completely go against the objective to have more proportionate rules. The more so that firms of our type of risk setup, in case they would need to wind down, could close their trading operations very quickly. So there is no material reason, in our view, to actually calculate those trading and clearing fees to the fixed overhead requirement. So that's a big concern. The other concern, which also was briefly mentioned already, is with regard to the calculation of the assets that count to the 30 billion class 1 threshold. And there actually have been now 2 proposed RTS by the EBA, the most recent one from June, where we see a proposal where a small investment firm in the EU, say with 2 billion of assets, could actually be considered a class 1 institution, so a credit institution, a bank, just because it happens to be part of a group which, for example, would have 15 billion of assets in Japan and 14 billion of assets in Australia. That counts up to more than 30 billion. And then according to this new logic in these proposed RTS, this small EU firm would need to be organized as a credit institution, which we think is counterintuitive. It actually would affect a number of my members, but also of other types of firms, especially dealer-type firms with a liaison to, for example, Canadian or Australian or Japanese or other third country institutions. We really think that this makes the EU less attractive for investment firms, that it also can have negative impacts on market liquidity and also on a number of EU policy objectives, for example, around the incentives to have more euro clearing in the EU, strengthening of the euro as a global currency. All of that stands and falls by having a diverse community of investment firms in the EU, and by making the EU less attractive for investment firms by basically applying counterintuitive calculation methodologies, we do not think is the right thing to do. The more so as we believe that the level 1 does actually should actually be read differently to ensure that only EU assets are counted when you need to calculate this 30 billion threshold.
Thank you very much, Pibe. Very helpful. I think we can agree on a lot of positions things you just said, particularly also on the fixed overhead calculation. An investment firm who decides to shut down its business does not have trading fees and clearing fees anymore. So the question is why to hold them. I think we are running out of time with our panel. May I take the opportunity once again to thank all of you for participating today and giving Udo Franke, Peggy Steffen, and Emmanuel a last chance to say 2 sentences, let's say, what are, from your point of view, the most important next things to do, what we are waiting for on the level 2, what shall regulators and legislators do first now? Peggy.
I think that the first work would be the categorization of investment firms and the calculation of the key factors and the group context, and to finish the outstanding level 2 and level 3 requirements. This is important that this framework will be or will be a successful framework at the end. And I think we need to monitor this framework, and maybe we need to discuss a review in 4 or 5 years at this stage again.
Thank you. Emmanuel? Yeah, I totally agree with Peggy. Yeah, we've got to make a lot of fine-tuning on a lot of subject, and then think about IFR2, EFD2, but not today. We have, I think that the EBA should provide other RTS, notably on the ESG requirement, and I think it will be a huge challenge to follow this topic, because we have more. It will be more complicated to implement, and it's a real challenge. And I think that as association, we will have to follow what they have in mind about ESG requirement within the prudential regulation. It is done within the CRD5 regime, but not in IFR regime.
I see. Yes. Udo, from the Ministry of Finance perspective, you already mentioned we have still some outstanding work on level 2 and level 3. So what's most important and should be done most urgently from your point of view?
Yeah, I think the ITS on reporting requirements should be completed and set into force soon, Article 54 of the IFR, because this is a basis for supervisors to get a better assessment of the effects of the new regulations, and this is a basis for supervisory assessments and supervisory actions.
Thank you very much. If I'm correct, we haven't received any Q&As. So let me take the opportunity once again to thank you for participating today. It was a very interesting and thoughtful and insightful discussion, I think. We will stay on this topic, and certainly we will have a review on these issues we discussed today in one of our next conferences. Now it's my pleasure to hand over to Dr. Annette Kliff-Müller-Frank, the chair of BWF.
Thank you, Michael. Ladies and gentlemen, many thanks to all panel experts for the very interesting discussion. We see the new prudential regime finally opens a real opportunity to put the principle of proportionality into practice. Let's take this opportunity and continue. We need regulation that is moderately tailored to our business activities and to our business risks, and that avoids the over-regulation which obscures the focus on what is important. But we should avoid an overloading on level 2 and 3 too. That's where the trend is going on now, and that can put the principle of proportionality in question. In the name of BWF and ICMA, very special thanks again to Mr. Cookies, State Secretary, Federal Ministry of Finance, Germany, for his keynote presentation, Thanks to all our honorable panel experts, Rick Hansen, Thomas Richter, Alice Saiwiesen, Emmanuel de Fournou, Udo Franke, Peggy Steffen, and Piebe Thebon for the informative and valuable contributions. To Martin Scheck, President of ICMA, for his good introduction. To Andy Hill, Senior Director, Market Practice and Regulatory Policy of ICMA, and to Michael Sterzenbach, Secretary General of BWF, for their good moderation, and finally to Ravina Patel and her team for the technical organization. Many thanks to all delegates and participants for the interest and attention. I sincerely hope that we can finally meet again in person at the next Capital Markets Conference of BWF and ICMA in 2022 in the German National Library in Frankfurt. Thank you very much for joining this virtual event. I wish you all stay healthy, take care, and goodbye.